The People's Bank of China raised interest rates again this week, highlighting that authorities are yet to tame the inflation dragon, despite a softening economy. And like Europe and the US, China has some serious debt problems. For his view on the state of play there, I spoke to ANZ's head of Greater China Economics, Li-Gang Lui. Li-Gang Lui, China raised interest rates 25 basis points this week, but that's only a fortnight after Wen Jiabao declared victory over inflation in an article in the Financial Times. So clearly there is still an inflation problem.
Indeed, we think that China's inflation will not peak after June. In fact, with the recent flood in rice-producing Chinese provinces, Chinese food prices will continue to rise in the next few months. So our projection suggests that Chinese inflation will not peak until August or September, and China's CPI inflation for the year as a whole will be around 5.8%, with a peak value close to 7.8%.
So are you still looking at a soft landing in the Chinese economy?
Indeed, we still think China's economy is heading to a soft landing. The People's Bank of China suggests that Chinese Q2 GDP growth could be still relatively strong.
In the context of interest rates, you wrote recently that Chinese depositors are subsidizing investors and banks, and that this is distorting the Chinese economy. Can you explain that, and is it still the case?
Indeed, at this moment, with expected June inflation at around 6.5%, even with the rising lending, deposit rate, Chinese ordinary depositors are still suffering a negative real interest rate as high as 300 basis points. This means
3%. They're going backwards by 3% per year.
That's right. That means they are subsidizing, borrowers, investors, and to some extent the banking system. If this were to continue, and with a higher inflation expectation, Chinese depositors may shift their deposit outside the banking system and put their money in trust funds and other high-yield assets. That will create a new problem for China's banking system.
At this stage, it results in them buying a lot of property, doesn't it, in buying apartments?
Indeed, according to the recent PBOC survey, Chinese consumers still prefer to put their money in property market.
There's a lot of concern around the world with the high level of debt in local governments in China. Is that a concern to you?
We know in the Chinese fiscal stimulus package, it's quite sizable, 4 trillion renminbi announced in the late 2008. At the time, the central government only financed 30% of the fiscal stimulus package. Then the rest was left for the local government to come up with money to finance the fiscal stimulus package. So as a result, they have to borrow from the banking system. That's how they come up with such a large fiscal liability.
Right, so but is that an accident waiting to happen now?
Well, I think, with proactive policies, this problem can still be manageable. The reason is that if you look at China's fiscal debt as a share of GDP, it's still quite low.
What's the term of the debt? The bank debt that the local governments have undertaken, what's the term of it? They invested in a long-term infrastructure, didn't they?
Indeed. Basically, most of these investment projects are infrastructure related. These type of infrastructure will take a long time to yield return. Meanwhile, they have to pay back loans almost immediately once they get the loans.
That seems terrible. I mean, they've borrowed, all these local governments have borrowed from the bank to build their roads and other infrastructure. They're going to repay the money to the banks. What's going to happen?
I would envisage several ways to handle this current problem. First of all, central government can help local government to issue some debt. The second solution could be, Chinese commercial banks could lengthen their current 5-year loans to 7 years or even longer loans. The local government can also privatize this project by selling these infrastructure projects to private investors using the proceeds to pay off their bank liabilities. So if you look at these possible solutions, I would still say the current problem, local government debt problem, can still be managed. This will not degenerate into a serious banking crisis
so
in China.
So it'll be the central government bail them out, like the European government is bailing out Greece, I guess.
There are some similarities here. The problem is that Chinese central government is well endowed fiscally, but the local government is running a lot of debt problem, and given the current Chinese government structure is a unitary one. Actually, whatever the liability owned in the local level is also the central government liability. So in that sense, it's very unlikely that the central government will not step in and bail them out.
Thanks for joining us, Li-Gang Lui.
Thank you very much.